So want to go ahead and introduce Michael Gayed. His presentation today is Before It's Too Late, using lumber and gold to actively manage stocks and bonds. And obviously with what's been going on in the market this year, it'll be interesting to see kind of what your outlook is, and what the expectations are, especially with the Fed and with the outlook for the economy. Michael is a portfolio manager at Toroso Investments, an investment management company that specializes in ETF-focused research, investment strategies, and services. He's authored 5 award-winning white papers on stock market anomalies, one of which is the 2015 Founders Award study titled Lumber, Worth Its Weight in Gold, Offense and Defense in Active Portfolio Management. His research focuses on predictive power of 2 seemingly unrelated commodities, which provide important information on the economic cycle and risk-seeking behavior in various assets. Prior to his current position, he was a co-portfolio manager and chief investment strategist at Pension Partners. He was an active contributor to Market Watch for a number of years and has been interviewed on CNBC, Bloomberg, and Fox Business, as well as the Wall Street Journal Live, for his unique approach to interpreting market movements. He's a fellow charter holder as well and earned his degree with a double major in finance and management at the New York University Stern School of Business. So with that, Michael, I'll turn it over to you.
I appreciate that. Everybody can hear me okay? By the way, I have this headset on because I'm simultaneously streaming this on Twitter Space, so don't think I'm too weird for looking like a little bit of a cyborg today. My name is Michael Gayed. As mentioned, I'm the portfolio manager, one of the portfolio managers at what is now renamed Title Financial Group. I go around the country doing presentations on these different research papers that won these different awards. I believe in the findings so much that I launched funds using derivations of the concepts. And I believe in them so much that despite the hell of this year, I continue going through hell. Now, this presentation is titled Before It's Too Late for a reason. Most people tend to fix the roof after it's rained. When you look at studies on car crashes, you know when most people hit the brakes? After impact. After the crash. This is not my opinion, because your body's in motion. Most people tend to manage risk after the fact. Most people, by the way, tend to focus on the mile marker, not the conditions that favor the accident. Too many people focus on what's the call, not what are the conditions that lead to the probabilities that lead to the outcome. This presentation is about conditions. Not in terms of investing in lumber and gold, but rather as using lumber and gold as signals when it comes to identifying the conditions under which a tail event is likely to occur in equities, in the risk-on asset. Those that are on Twitter listening to this, this is a live presentation I'm doing at the Richmond, Virginia chapter. I'm going to be adding some new content, so if you've heard this before, stick around and show a little love and retweet so that people actually pay attention to what I'm saying here. If you are on Twitter here in the audience, feel free to connect me. Handle is @LeeLagerport. Please don't be a hater. I've got 700,000 plus Twitter followers. Some of them are frankly just mean. If you're on LinkedIn, feel free to connect me there. That way, if you're a hater, at least I know your name. Okay. So, portfolio manager at Title Financial Group, we've got, as a firm, as an RIA, around $7 billion or so in assets. In addition to my own funds, we are the ones behind the blockchain ETF, BLOK. We helped bring the risk parity ETF, RPAR, to market. By the way, a lot of the dynamics of my hell this year relate directly to the dynamics that risk parity are going through this year. I won 2 awards from the CFA Association, one in 2014 and one in 2016, the Dow Award, and then 3 from NAME, the National Association of Active Investment Managers. The awards don't mean jack shit. They just mean that people think I'm cool. I have my own research separate from my funds. that I call the lead lag report. Everything that you see on Twitter and in social media is around that banner. And as mentioned, I used to be on CNBC, Bloomberg all the time. Please don't hold that against me. As somebody that has done the media rounds in the past quite actively, I will tell you it is unequivocally true. Most people on TV have absolutely no goddamn clue what they're talking about. There are very few things that have predictive power in markets. Very, very few things that have predictive power. It's always amazing to me how people talk confidently without actually having ever done a back test about what they're talking about. And yet they'll talk about buy and hold, which is a back test. If you want to contact me, that's my email address. I try my best to communicate one-on-one with as many people as I possibly can. Now, I always start off with a quote in pretty much most of my writings. This is one of my favorite quotes of all time. There is always a disposition in people's minds to think that existing conditions will be permanent. When the market is down and dull, it's hard to make people believe that this is the prelude to a period of activity in advance. When the prices are up and the country is prosperous, it is always said that while preceding booms have not lasted, there are circumstances connected with this one which make it unlike its predecessors and give assurance of permanency. The one fact pertaining to all conditions is that they will change. That's by Charles Dow, father of the Dow Jones Industrial Average. This is a presentation about identifying conditions beyond the small sample of the here and now. Now, I mentioned these 5 different research studies, 2 that won the Dow Award, 3 that won the Founders Award. All of the papers that I put out there since 2014, which, by the way, were all anonymously submitted, all of them use a field of study called intermarket analysis. Okay, what is intermarket analysis? Intermarket analysis is a branch of technical analysis. We all know what technical analysis is, right? Here's a chart, here's price, moving average, support, resistance, yada, yada, yada. True technicians don't really care what they're looking at, right? They just care about price movement. They don't care if it's Dogecoin, they don't care if it's Apple, they don't care if it's long duration treasuries. All they care about is price movement. Intermarket analysis is different. Intermarket analysis says that what you're looking at matters. That the relative movement across asset classes, across sectors, might show you the whites of the eyes of regime change to come in markets. And it's that lag that you can take advantage of from an asset allocation and trading perspective. Classic example of that is the relationship of oil to bonds. When oil prices rise, what tends to happen to bond yields? Do they rise or fall? They rise, right? Why do they rise? Because oil is a form of cost push inflation. So if oil rises, now you've got to increase your inflation premium as a bond investor. The key thing, though, is that it doesn't happen right away. There is a delay. Oil tends to move first, then bonds follow, which actually make you all very bullish on bonds. Now, I have here a picture of my father's book, Intermarket Analysis and Investing. My father, some of you may remember the name Bob Farrell of Merrill Lynch, Farrell's 10 Rules, right? I'm actually trying to get him on my Twitter space, hopefully next month. He's 90, God bless him. Considered one of the godfathers of technical analysis. My father worked on Bob Farrell's team in the late 80s at Merrill Lynch, alongside a gentleman named Steve Shobin, who I happened to email this morning, who was well known in the 90s at Lehman Brothers. My father wrote 2 books on markets, one called Challenge of Generation, Beyond the Crash of '87. I kind of feel like I should rename that to Beyond the Crash of 2022. And then this book in 1990, Intermarket Analysis and Investing. Now, this book was never a runaway bestseller. After my father passed away in '08, I got the rights to the book back for $1. And I republished it in 2013. Despite this book being over 30 years old at this point, it's still very, very relevant to today. That's Amazon delivering the book. Now, if you're going to read this, if you're going to get it from Amazon, please do me a favor and be honest when you review it, which means give it 5 stars. Okay, now, I broke this presentation up into various sections. We're going to talk about asset class diffusion, why lumber, why gold. Go through various back tests to prove that this stuff works. Go through some examples, and then I'm going to add some new material related to this year. And again, the hell that I've been referencing all the way back to March, April. Michael Burry on Twitter calls himself Cassandra. Cassandra in Greek mythology was cursed with the ability to see the future, but she couldn't do anything about it. He made money in this. He's not Cassandra. When you manage prospectus, you are Cassandra. Now, let's first talk about asset class diffusion, which is the opposite of the efficient market hypothesis. Traditional studies, when you look at academic work around anomalies when it comes to how do you, quote unquote, beat buy and hold, beat passive indices, most studies look within an asset class for different factors. Okay, think momentum, value, so on and so forth. Most academic studies, when it comes to markets, look within an asset class. There are different ways to look across asset classes for anomalies, okay? Which again goes back to intermarket analysis. To see if there's spillover that one part of the marketplace has on another that the other part of the marketplace does not notice right away. And it so happens that commodities are one of those asset classes that tends to have spillover relative to other parts of the marketplace. The movement of commodities tells you something that other risk assets don't necessarily react off of right away. And it turns out that lumber, relative to gold, is one of those relationships. Now, I mentioned I have a large following on Twitter, and I'll always get some person being snarky saying, why the hell do you focus so much on lumber? This is weird. As they tweet from their house. I just gave away the entire conclusion. So let's talk about lumber. The media always focuses on copper, Dr. Copper, because of the link to industrial activity. The media always focuses on oil, especially lately. Makes sense to a degree, and there is some evidence that these are predictors of risk assets. But I've tested all kinds of different relationships, and it turns out that lumber is one of the most important commodities to watch of all. The media is massively underestimating the importance of lumber. With the exception of last year, you never had the media talk about lumber. Last year because of the sawmill disruptions. And again, the link is around housing. Why is lumber so critical? Because the average home has 16,000 board feet of lumber. Okay, Lemur showed that housing, we know, is one of the leading indicators the Fed follows. Housing tends to move in advance of expansions and recessions for the economy. Makes sense. And Rucker, Thurman, and Yoder showed that lumber prices react instantaneously to housing starts data. Again, it makes sense. There's a long tail of construction. Okay? Now, lumber, even with these E-mini futures that recently came out, lumber is one of the least actively traded futures contracts. I'd argue that it actually makes it a much purer signal than other commodities because you don't have speculators. It's ultimately about hedging. Okay? So lumber tells you about housing, and we all agree that housing is a pretty big driver of the economy, makes up about 18% of GDP. So look at U.S. building permits. Going back to 1960 to 2020, you can see clearly building permits tend to fall in advance of a recession. They tend to rise in advance of an expansion. Okay? So we're cool, right? I'm not too weird focusing on lumber. What about gold? All right, so we got a whole bunch of CFA charter holders in this room. Raise your hand if you think that gold is an inflation hedge. Oh. Guess people looked at the performance this year. How many think gold's a deflation hedge? How many think that gold does well based on currency movement? Oh, okay, interesting. How many of you have no goddamn clue what the hell gold moves off of? That should be everyone. Okay. Here's the truth about gold. Gold doesn't correlate to a damn thing, except narratives. This is based on pure data. Lawrence did a huge study looking at all kinds of macroeconomic variables you can imagine. Gold doesn't correlate to a damn thing over time. This is a look at the correlation on a rolling 12-month basis of the S&P to gold, you can see pretty much zero. Now, by the way, that actually makes gold, I would argue, the ultimate diversifier. What's diversification about? Correlation. By the way, those that are in this room, if you don't have a portion of your portfolio that you hate, you're not diversified. Why am I saying that? Because you're going to hate the portion of your portfolio that's not working, which I'm pretty sure has to do with correlation. I think nowadays it's fair to say everybody hates their portfolio. Yeah. Now, the one thing that gold does tend to move off of is risk-off pulses in equities. Meaning, when you have high volatility for a moment in time, gold tends to do fairly well. You only have really 3 risk-off plays that benefit from stock market volatility historically. Number one, first and foremost, is Treasuries. We'll talk about this here. Second is gold. Third is the dollar. From a sector perspective, utilities are the equivalent of the Treasury trade. That's worked this year. Okay? But when you think about risk-off plays, you don't have that many options. Those areas, Treasuries, gold, and the dollar, I'm pretty sure people hate. They are the diversifiers. Okay, now, you're going to hear me say this a few times during this discussion. Every strategy, every portfolio must have 3 things. Undeniable. 1, what is your signal? Moving average, MACD, fundamentals, whatever it is. Whatever your signal is. Okay? 1 is your signal. 2 is your look-back period. You're going to choose a 200-day moving average or a 50-day moving average. Okay? Earnings over the last year, 3 years. Okay? So signal, look-back period. And the third is your opportunity set. How do you express that signal with that look-back period in practice? Now, this slide is about the signal. So the signal is lumber relative to gold. Lumber as the cyclical housing play, gold as the non-cyclical risk-off play. Now, whenever you do a back test, you have to choose that look-back period. So Mifri and Morales, in a separate paper, show that commodities as an asset class tend to have the most momentum at the rolling 3-month time frame, or the rolling quarter time frame. Okay? 3 months. So let's convert 3 months into a rolling 13 weeks. 3 months, 13 weeks equivalent. Okay? Let's make that the look-back period to do various back tests and make a very, very simple rule. Very, very simple, stupid rule. If lumber is performing better than gold, if lumber is outperforming gold, just straight up holding period return, up more, down less. Let's take that as the signal to play offense, risk on. Okay? Lumber's doing better, get aggressive. If gold is doing better than lumber over the last rolling 13 weeks, let's take a step back, let's play defense. Risk on, risk off. Only looking at the performance differential of lumber against gold. Now, keep in mind, 13 weeks is not some magic number. It's just the number that was used in the paper. If you do these back tests, whether it's rolling 3 weeks up to 26 weeks, it still works. So the look-back period is not as important in this. Okay, but I want to just kind of emphasize one particular look-back period, the 13-week, at least to give you something to latch onto. And you're evaluating that lumber-to-gold relationship every rolling week for shifts in whether it be offensive or defensive. Again, those on Twitter, stick around. There's going to be a lot more towards the end of this discussion. Now, it's important before I show you that this works to understand what it really tells you about. What does it lumber and gold tell you about? Lumber and gold tell you about volatility changes. Okay, so this is a look at the S&P 500's annualized volatility when lumber is outperforming gold. So the volatility of the S&P when lumber is outperforming gold on average is around 12.5%. When gold is outperforming lumber, that volatility for equities rises to around 17%. 12.5 versus 17. Okay? Another way to look at that is to look at the VXO index, which is kind of like the VIX, longer history. It's a level. Lumber outperforms gold. The average level of the VXO index is 18.3. Gold outperforms lumber. It's around 22. Why does that matter? Why does volatility matter? Because it's in higher volatility states when you tend to have accidents. It's when you tend to have major crashes, corrections, and bear markets. It's when you're already moving around violently in equities. Now, this drives me crazy about the media. Whenever the market is up, they say it's a risk-on day. Whenever the market's down, they say it's a risk-off day. Risk on, risk off has nothing to do with direction. It has everything to do with conditions that favor lower or higher volatility. The weather. You can be up, being led by defensive sectors. That's a risk-off day, because there's defensive posturing underneath the surface. You can also be risk-on in a big down day if it's led with technology and other areas being down less, which tends to be, by the way, when you tend to have an inflection point in equities. So risk on, risk off is ultimately about volatility. Now, this is another very important point. Risk off doesn't mean no risk. Risk off does not mean cash. I'm going to prove to you why I say that in a second. The term risk off is ultimately about default risk off. It's why you tend to have that flight to safety trade, except this year in Treasuries. A very well-documented phenomenon beyond my own papers. I'll prove that to you in a bit. As it relates to volatility, when the volatility is rising, what happens to credit spreads? They blow out, they widen. There's a direct link between the VIX and the bond market reassessing default risk premiums, which is why Treasuries tend to be the beneficiary, as opposed to the source of risk like we're seeing this year. Okay, now let's talk about backtests. Again, signal, lumber to gold, look back period, rolling 13 weeks. Now let's define the opportunity set. So I have here a spectrum of risk from low vol to high vol. This is updated through end of 2020, so obviously some of these will look quite different, especially when it comes to Treasuries, but not that much over the full cycle. Lowest volatility, lowest beta tends to be 5-year total return Treasuries. Default risk off. Buy right index, this is originally from the paper, right? So it's just sort of showing and outlining your opportunity set. The S&P is your baseline for risk on, risk off. Notice I did not include cash and shorting. I'm going to explain that to you in a second. Okay? But this is the opportunity set we play with, from most defensive to most offensive. I'm going to select certain back tests in this presentation and talk through it. Don't focus so much on the numbers. I'll talk through it. And again, I go back to everything in markets is a backtest, including buy and hold. Everything in markets is a backtest. You cannot get away from looking at history. I have so many people on Twitter seeing the performance of my rules-based funds saying you should change your strategy based on the small sample of this year. And you know what? This year is a small sample. By the way, inflation may still be transitory. Why do I say that? Because nobody frickin' defined what transitory was. 3 years could be transitory in the context of a generation. Okay. I'm going to get increasingly fired up during this conversation. So, I'm going to show you a series of backtests. Now, this backtest is very simple. Lumber outperforms gold. Volatility for equities tends to be lower on average than when gold's outperforming lumber. Let's call that risk on. Let's go all into the S&P when lumber is doing better than gold. Gold does better than lumber. Let's go all in risk off 5-year Treasuries in this backtest. Okay, so all in equities, risk on, all in Treasuries, risk off 5 years. So it's got some duration, but not as much volatility, obviously, as the very long duration ETFs that are out there. Here's that backtest from 86 to 2020. By the way, I'll talk about pre-86 towards the end of the presentation, but this original paper is from 86 to 2020. Total returns around 3,300%. The S&P buy and hold is 3,000. So it actually beats the S&P, all in equities, all in Treasuries, using this stupid lumber to gold relationship. But notice that the Sharpe ratio is quite a bit higher, 0.77 versus 0.44. Sortino ratio is quite a bit higher. Your max drawdown, again, not updated for this year, is down 16 versus down 54 for the S&P. The annualized alpha is 780 basis points rotating equities and Treasuries, 5-year Treasuries, using 13 weeks and using lumber to gold as your signal. That should not exist in any single CFA material. This is a look at the drawdown profile of red, the S&P, buy and hold, blue, that all in equity, all in Treasury rotation. Again, not updated for this year. Anyone want to tell me where most people sell? What the hell? Get me out. Oh my God. I'm a Luddite. Lehman's going under. I'm going to sue. It's the end of the world. Notice that the drawdown, on average, is quite a bit less rotating equities and treasuries, 5-year treasuries. Why does this matter? I always say that your ability to stick to a strategy matters more than the strategy itself. Your ability to stick to a strategy matters more than the strategy itself. I don't care what diet you follow as long as it's not the old cupcake diet. I don't care what diet you follow, you're going to lose weight. As long as you stick to it. Right? Discipline is always the missing ingredient. What's the joke about buy and hold? Nobody holds. You know, for all this talk about being a buy and hold investor, somehow investors want to buy the ETFs that have the most trading volume. Why should you care about that if you're supposed to be a buy and hold investor? To the extent that you are able to cut off your tail risk, you're much more likely to stick to a strategy. That's why I'd argue that this, over time, tends to be a much better way of thinking about a portfolio, rather than the hypothetical, which is up and to the right when you go back to the 1900s. Totally factoring out all the nasty drawdowns in between. Again, I'm going to touch on this here in a bit. Now, that's treasuries. This one is actually particularly interesting. What if instead of risk on S&P, risk off treasuries, you said risk on S&P, lumber outperforms gold, risk off S&P low vol? Okay, so either the S&P is your risk on or SPLV as a proxy. Low volatility basically weights the most defensive sectors of the market, heavier utilities, staples, and healthcare. So beta of 1, beta of less than 1. Beta of 1, beta of less than 1. Buy and hold returns 4,000% versus 3,000. So you beat buy and hold. Max drawdown's 44 versus 54. Annualized alpha, always being equities in this case. You're always equities, right? Is 270 basis points. What does the CFA curriculum teach us? If you want more return, what do you have to do? Is that true? Maybe it's not about taking more risk. Maybe it's about taking the right risk at the right time. Maybe it's about identifying the conditions under which you slow down and then speed up. It is amazing to me how people live their lives, but they don't apply their lives, what they do daily, to their own portfolios. You put any destination in your GPS, in your phone. What is the biggest driver of variability of your ETA? Traffic. The downside. It's not about how fast you go. Okay, now this one's also particularly interesting. Instead of focusing on S&P being risk on, risk off being either treasuries or low vol S&P, let's switch the roles so that if lumber is outperforming gold, you're all in small caps. That's the risk on play. IWM, Russell 2000 proxy. Gold outperforms lumber, you're large caps. So all you're doing here is playing with market cap. Offense, small caps. Defense, large caps. Always equities. IWM, SPY, SPY, IWM. So here's the buy and hold the Russell 2000. 2,000% versus 3,000 for the S&P. Here's the rotation of the two, 6,400%. Basically more than double the S&P, triple that of small caps. Simply rotating around the two using this very stupid lumber to gold relationship. Now this to me has always been interesting. Why is that? There has to be causation, right, with any kind of strategy. There has to be causation. Otherwise, it could be randomness. Okay, so what's the causation here? Well, if lumber is outperforming gold, it tells you about housing. Construction picking up. It tells you about credit creation. Probably tells you about consumer wealth, right? Well, what's more sensitive to the domestic economy, to the consumer, small caps or large caps? Makes sense, it would be small caps, as opposed to multinational large caps. So there's a logic here as to why using small caps as risk on and S&P as risk off makes sense. Now, best defense, historically, with the exception of this year, is 5-year Treasuries. Best offense is small caps. So let's combine the two. Lumber outperforms gold, IWM. Gold outperforms lumber, 5-year Treasuries. You get this very nice smooth line, $10,000 in 1986 becomes $901,000 total return, versus for the S&P in purple, 361 versus Treasuries, 220 something. I'm sorry, 79 here, and then small caps is 200 something here. Okay, so way outperformance buy and hold, right? Okay. Who wouldn't want to buy that, right? That's a nice looking chart. I can extrapolate that forever. What do you notice is happening here in the mid-90s? Again, this is the lumber to gold strategy. Small caps, Treasuries. Here's the S&P. What's happening in the 90s? It's catching up, right? Closing the gap. It actually overtakes it. Let's say you happen to launch this strategy right in 1995, and the market is running away from you. You going to stick to it? If you manage money for clients, will they let you? We live in the small sample. And there are cycles in everything, not just in buy and hold, but also in tactical, in anomalies, in factors. This didn't invalidate the strategy, just like this year doesn't. Now, why does this work? Okay, so remember, it's about volatility, right? Okay, you do any kind of analysis on different funds or strategies, there are these two metrics called up capture, down capture, right? What percentage against some benchmark do you capture on the upside when that benchmark is positive versus when the benchmark is negative? Notice that the up capture of that small cap treasury rotation is only 60% against the S&P. What does that mean? It means if the S&P is up 10%, on average it's up around 6. It actually lags pretty badly. And by the way, that should make sense, it lags. Why? Because there are going to be plenty of times where you play defense, you're risk off in treasuries, and you're wrong. You slow down entering the storm, you never have the accident. So you have to be lagging the market because you're missing some of the upside. Playing defense at the wrong time. When the conditions are there, the outcome's not. So how do you generate all of that alpha I just showed you in the prior chart? It's purely around the down capture over time. Down capture around 18%, meaning the S&P is down 10, on average it's down 1.8, using 5-year treasuries. Remember I said in the beginning, there's a reason why I didn't include cash and shorting. Let's play out this up capture, down capture, false signal idea for a moment. If your opportunity set is cash, what's the problem with cash? You're wrong, you play defense, you have no chance at compounding. You're cash, right? You're not going to move. So your up capture is going to be even worse, right? Because the benefit of low volatility stocks is that they're still beta. So if you're wrong, you still go up. The benefit of treasuries is that if you're wrong, you still have yield. You have a chance at making money. A chance, not a chance this year, but a chance on average. What's the problem with shorting? And you're wrong if you're shorting, the market goes up. If you're wrong when you're shorting, you lose money 1 for 1. Your up capture actually goes negative. Remember, signal, look back period, opportunity set. By the way, what's one way you can up this up capture of 60%? Leverage, right? If you're getting most of your upside from equities, from the risk on side, well, let's lever up the up capture. Kind of makes sense. Of course, that's a double-edged sword because you could be wrong being risk on too. Now, this is from 86 to 2020. Why? Because the lumber futures continuous contract on Bloomberg only started in 86. I was able to find data going back to 1975 from Quandel, which is, I think, recently renamed to another data provider. There you go back to 75. I did an update on the paper factoring 1975 to 86. So those that say this is because of the 40-year bond bull market, the data that I have in the paper that's updated prior to Volcker shows unequivocally you still get to the same place cutting off the tail risk of equities. Because even in the 70s, Treasuries acted as the risk-off safe haven for a moment in time. I'm going to prove that to you in a second. Now, nothing tells a story quite like charts. So let me prove to you that this works visually. Those on Twitter, I will try to share this in a bit. I'm going to show you a series of charts here. All of them are the exact same, except the dates are different. Top here is the ratio of lumber to gold. Rising ratio means lumber is outperforming gold. Falling ratio means gold is outperforming lumber. Risk on, risk off, risk on, risk off, risk on. Okay. Here's the 13-week rate of change, the look-back period, the trigger in the paper for the back test. On the ratio, okay, you're above the red line, you're risk on, you're below, you're risk off. Here's the S&P in 1987. Here's the VXO VIX-like index. Before Black Monday, a full month before lumber to gold told you risk off. The conditions were there for the accident. Well, Mike, what about this? Yeah, that's a false signal. But did you lose money being in Treasuries then? Did you lose money being in low vol then? Remember, it's not just about how many times you're right. It's about can you make money when you're wrong. Maybe that's luck. Here's 1990. Now, this was a housing recession, so it kind of makes sense that lumber would tell you in advance of a bear market. Same deal, ratio of lumber to gold, rising ratio risk on, risk off. Here's the 13-week rate of change. Here's the S&P in 1990. Here's the VIX-like index before it's too late. Lumber to gold warned you in advance of that, the bulk of the bear market from 1990. Maybe that's luck. How about 2000, 2001, 2002? Same exact series of charts, same exact signal, same exact look-back period. Lumber to gold, rate of change, S&P, VIX in 2000, 2001, 2002. The dotted lines clearly show you, it's not my opinion, that before it was too late, you could have avoided these VIX spikes. Even in the tech wreck. Y'all remember Lehman Brothers? 2 weeks before Lehman Brothers. Same charts. 2 weeks. Here it is. You could have avoided the bulk of that crash if you just looked at the way lumber was behaving relative to gold. Remember when S&P downgraded U.S. credit quality in 2011? And the Eurozone crisis? Just before the summer crash of 2011, same deal. Lumber to gold warned in advance. Now, by the way, this is kind of what's interesting about, I'll relate it to this environment that we're in a second. So S&P downgraded U.S. credit quality, but you remember what happened to Treasury yields back then? They collapsed. And then the stock market collapsed at the same time. So the U.S. government has poor credit quality. It did better as an asset class, Treasuries, than being in stocks at that moment in time. It kind of makes sense because the government owns our shit through taxes. You cannot say that what's happening or what happens based on the creditworthiness of the U.S. government does not affect the stock market. That is insanity. Utter insanity. The entire baseline of the economy is based on the risk-free rate. What happens when the risk-free rate is the riskiest? Now, this paper originally was published in 2015 when it won the award. So let's do some out-of-sample testing. Here's 2018. Remember the fourth quarter, the Christmas Eve massacre in 2018? The Dow was down 1,000 points. Everyone's like, Christmas sucks. All right? Same deal. Lumber to gold warned way early in this case. You can see it pretty much stayed risk off. It did stay risk off the entire time before that very nasty decline in Q4 of 18. Now, this is interesting because in this case, notice the lag was actually pretty big. The signal was really, really early. Okay? But it did help you avoid that. And then, of course, COVID, just before the lockdowns, lumber's collapsing, goes risk off before the COVID crash. Now, what about this year? Now, I mentioned I am a portfolio manager. I do the research. Everything I do is quant-based. I am very loud on Twitter because, unfortunately, that's the shit that gets attention. But the reality is, at heart, I'm all about looking at true, back-tested quantitative relationships. By the way, anybody can replicate this stuff. It's all publicly available. There's nothing magic about it. Okay? So, I have my mutual fund that I launched in 2012. Much more complicated version of risk on, risk off. Uses utilities and treasuries as the trigger. Usually when utilities are strong, lumber to gold is weak. They all tell you about changes in interest rate movement. Utilities are the most bond-like sector of the market. When they outperform, that suggests defensiveness, demand for money dropping. Same deal with lumber because of the transmission mechanism of housing. Okay? So there's often a correlation there. Mutual fund I launched 2012, only had really 2 very good years, 2018 and then 2017 and then 2020. It's risk on, risk off, all in equities, on Treasuries, uses leverage when risk on. Mutual fund in 2020 had its real war story. It was up 72%. Before there was Cathie Wood, there was Guyad. At least for a moment. Why? Because that mutual fund was risk off in Treasuries mid-January of 2020, stayed there throughout the entire COVID crash, then rotated risk on into equities March 31st. A couple false signals along the way, but you can see how a very concentrated period of a real risk-off dynamic can result in significant performance. Then last year it goes down 10, this year it's down around 30. But it's a risk-off year. Are you sure? So I joined Tidal Financial Group early 2020 as the pandemic's starting, did the proxy of the mutual fund, and immediately say to the guys, okay, I want to launch 2 ETFs. Well, first I said, let's launch RoRo, the first ETF. So RoRo ETF, I started the process in April of 2020. It takes about 4 or 5 months, start to finish, to launch a fund, an ETF, exchange-traded fund. Now, when it comes to ETFs, you can create a back-tested index and have the ETF in the prospectus say you're seeking to try to track that index. The index is a backtest. We went out to VanEck Market Vectors to create this RoRo index. Risk on, risk off, using lumber to gold as the signal. Lumber outperforms gold 1.3 times levered, again for the up capture. 1.3 times small caps, large growth. The way the index is constructed is lumber outperforms gold, 1.3x IWM, IWF. Gold outperforms lumber all in TLT, long duration treasuries. I launched the damn ETF here. So all people see on RoRo is this shit. It's down to like 46% as we're talking. Does that invalidate the strategy? I launched JoJo, junk on, junk off, as a bond ETF using the same concepts. When you're risk off, high yield spreads tend to blow out against the risk-free treasury side. So you're in TLT when you're risk off, you're in high yield junk debt HYG when you're risk on, junk on. Same deal. Here's the back test on the index that ETF seeks to track. Going back to mid-07 where HYG goes live, HYG or TLT, no leverage, as a bond rotation strategy, I launch here. All people see is this shit. Why did I launch the funds? This is not done by me, by the way, this index backtest. This is done by Market Vectors. Does that look like something you want to buy or sell? Now, why has this happened? This is my pinned tweet, pardon the language. Like I said, I'm very loud on Twitter. This tweet, thankfully, I say thankfully for a reason, got over 1 million impressions organically. This is the top 20 largest drawdowns for the S&P 500, peak to trough, largest declines in the S&P, going back to 1961, as far back as long-duration Treasury data exists. Gray is the S&P, purple is long-duration Treasuries, TLT. One of these is not like the other. You've never had, in history, a period where your risk-off asset, long-duration Treasuries, are down more than the S&P. Think about that for a second. And then put that in the context of everything I just showed you with my indices. Remember what I said? Signal, look-back period, opportunity set. All of my funds have been much more risk-off than risk-on this year. Why? Because utilities have been strong consistently. That's risk-off. Lumber to gold has been weak pretty much the entire year. The signals have been right. The opportunity set is what's wrong this year. But can you blame me for making Treasuries the risk-off safe haven when in 5% of the data set, it does this? And it happened to launch just before that. By the way, there's something interesting about this. First of all, this argument that it's because of the Fed is not true. I mean, yes, there's an element of the starting low yield, no disagreements, but we don't know if the drawdown in equities is over. Right? So maybe this relationship still holds compared to history. We don't know yet. The narrative that you should have seen this coming with the Fed is bullshit. This is a look at the drawdown of long-duration treasuries against the S&P, purple being Treasuries. Notice the drawdown started way before the Fed started hiking rates. By the way, even the narrative that the dollar is strong is because of the Fed is also bullshit. It started around April, that strength. The Fed didn't start hiking rates until really this year. We were still talking about vaccinations back then. Question all narratives, okay? Everyone says we ended the 40-year bond bull market. Have we ended the 40-year debt bull market of government spending? Do you really think that you have ended the bond bull market without having ended the government spending bull market? Who owns the Fed? Congress. Who owns Congress? Supposedly the voters. You think voters want austerity? Ever? It's beyond just the magnitude. Okay, what has happened this year has never happened in history. You look at the percentage of weeks that the S&P 500 has lost money this year as a percentage of the year. Take up all the weeks, the weekly data on the S&P, in terms of the negative weeks. Right now, you stand at 64% of the year using weekly data the S&P 500 has lost money. That is second only to 1931. This is not just about magnitude. It's about the path, the way it's playing out. You've never seen the S&P do that. Oh, never mind that. You look at long-duration treasuries, this is the number one year. You've never had a year in history using weekly data, 64% of the weeks, 70% of the weeks. Treasuries have lost money, meaning yields have risen. So not only are those as standalones extremes, but combined it's even worse. I got mocked for calling this a black swan environment before because people were beating their chest saying they saw this coming. Sure, you could have argued, like many did for 4 or 5 years, that stocks and bonds would have a period where they both lose money. No disagreements. Could you have told me the how it plays out? With the number of weeks down? With the interaction of the two in high volatility pulses? What's happening this year has never really happened. We are in an anomaly. Make no mistake about it, we are literally living in an anomaly. I put this tweet out a couple of days ago. Unpopular opinion. A bond market crash is infinitely worse than a stock market crash. It is amazing to me how people don't seem to understand that you cannot have a highly leveraged system working when you have this kind of volatility in rates. You're a company CEO. You want to figure out what to do for the next 3 years. How the hell are you going to know what discount rate to use when you have rates acting like this? You're going to tell me that what's happening here is normal. Have you been noticing what's happening in the UK? Guys, like what's happening is like heavy. Like heavy.
I've noticed it, I don't understand.
Say again?
I've noticed it, I don't understand.
Yeah, note it if you understand this. Right, to use my line on Twitter. Which, by the way, is me poking fun at the Bitcoin maxis because at the core, I'm actually deceptively humble. I make fun of those that are very certain about things because nobody knows the future. We are in a crash. A slow-moving crash, but we're in a crash. It's something more important than the stock market. Now, I put this out Saturday before that huge move 2 days ago. I'm going to relate it to this environment and lumber to gold. I said the end of the world is at hand. So I've been very disturbed all year long. I've said this as hell going back to April of this year because I see this Treasury and equity interaction. I'm managing my funds to prospectus that use Treasuries as the risk-off safe haven and high volatility. I couldn't do a damn thing about it. I mean, Treasuries, the bulk of the year, that 46% down move in RoRo is largely actually because of Treasuries and because it missed a couple of very big weeks in equities. JoJo's down 24, my mutual fund down 30. I believe you have two tail risks now. One is existential. Can the system survive with rates acting this volatile? I don't believe so. You may think I'm crazy, but I think if rates keep doing this, what we've seen this year, this is a system reset. The system cannot survive like this. When you have $31 trillion of government debt, never mind the $370 trillion globally in debt. Debt becomes deflationary when you cannot issue more of it. Okay? Which makes me ultra bearish. But as I said to my friend Todd Harrison via DM this morning, the fact that I'm ultra bearish is why I'm ultra bullish. Because I don't believe the end of the world is here. I believe they, in quotes, will find a way to kick the can down the road again. Because they can't afford a system reset because the Fed needs to keep its place. There's always a disposition in people's minds to think that existing conditions will be permanent. When the market is down and dull, it's hard to make people believe that this is a prelude to a period of activity in advance. The sentiment is so dark. I was one of the few people towards the March lows, having gotten the Treasury trade right in the mutual fund, to say, this is not the end of the world. We're going to find a way out of this. This year, the market has conditioned people to think it will do nothing but go lower because of the number of weeks as a percentage of the year. This is all recency bias. I'm pretty sure opportunity always exists when the crowd thinks it knows an unknowable future. Which is why I keep saying the end of the world is the bull case. Because I think we're there now. I think we're at this really critical inflection point where either yields and the bond market stabilizes, in which case it's off to the races, at least for a moment in time, in the context of a broader bear market, or we have much bigger things to worry about than being CFA charter holders. This is my Twitter profile. Lumber and Gold Eyes, which I put up last year to poke fun at all the laser eyes on Twitter, which was around the time that Bitcoin peaked. My whole point in doing this presentation is, one, to emphasize risk management matters. Two, on average, that you're not going to get every single sample period right. And three, just because you're in a dislocation does not invalidate your approach. It's partially me trying to convince you of that. It's partially me fighting back, because I happen to launch in this period. But the data is not deniable. So, with that said, I'm happy to do any questions. And by the way, since I forgot to do this in the beginning, I always do a giveaway at the end of these discussions. So for those that want to win a Kindle Fire, put your business card, pass that around if you don't mind. I'll do a drawing as we do questions here. I'm not going to spam you guys too much, don't worry. So I'll do a random drawing at the end. Any questions? Yeah.
I'll play the devil's advocate, also known as the academic. You looked at data from 86 until 218, right? And you basically mined the data to find these relationships, right? You agree that you mined it, and it's readily available data, which is actually quantitatively bought by NASDAQ.
Oh, it's okay, that's right.
And so you data mine, and then when you look at the 218, you see that it actually didn't do a good job, and it took a couple months. It reminded me of the thing that I saw in the Wall Street Journal many years ago, and it appeared in a February issue, and it said the January effect is late.
Yeah.
You know, that maybe this isn't an effect.
Mm-hmm.
And so, you know, also it's readily available data. Anybody can mine it. You've got all these people with machine learning going on, finding the magic formulas. And so if it really did exist, it would have disappeared.
We've been arbitraged away.
And so how do you argue against that?
Okay. So for those on Twitter that didn't hear the question, at the core it's about the data is available, so why is it still an anomaly, or is it an anomaly to begin with, because it could be randomness based on the data being mined. The original paper goes to 86. The extension with a Quandel goes to 75. And I'm glad I found that, because that counters the narrative that it's based on the 40-year bond bull market, the tailwind. Which, by the way, those that use that argument also assume that it's the end of the 40-year bond bull market. It may not be. But let's put that aside. I'm going to argue to you that the best anomalies and strategies in the world are the ones that don't work a lot in frequency. And I'm going to answer the question in terms of the arbitrage point. The best strategies are the ones that are actually wrong a lot, where you at least have a chance at making money while being wrong. Wrong being defined by volatility rising or falling, right? Okay. Why are the best anomalies or signals or strategies the ones that are wrong a lot? Well, let's take the other side of it. Let's say you've identified, because of data mining, some anomaly and you believe there's a causation there, some relationship over time. And let's say you have a strategy that can't lose. It's always working. Every single signal is a true signal, not a false signal, not a false positive. You're printing more money than the Federal Reserve. What's the natural response to that approach? Let's create a fund around it. So here's the strategy now that's publicly available. So people see this thing that's always working, so what do? They chase it. So what happens to the anomaly, to your point? It has to get arbitraged away because it can't lose, right? Everyone's extrapolating the most recent past to the future. But what happens if you have a strategy where it's wrong a lot in its signals, but right in a tail, which is the volatility event, the risk-off event? It creates doubt, right? Because if you have a number of false signals, people say this signal's not working, especially with the amount of short-term attention spans that people have. So I would argue to you that it's very hard to arbitrage this away unless you have real discipline among individual investors, and that's getting worse and worse. That's number one. Number two, unless the causation breaks around housing and the lagged effect of construction housing to the economy, you still can believe that there's some causation there. Right? At the end of the day, you still need to have a degree of causation with any strategy. Three, you could be right. Maybe it doesn't work anymore because the information is available out there. But then why does buy and hold still work? Right? Because we all know it's supposed to work, right? But it keeps on working. It's kind of like the Grossman-Stiglitz paradox. If everybody believes in passive can't work because you need active. There's these kind of cycle changes, right, based on those that are arbitraging an anomaly. So I don't know if that helps answer the question, but it's my belief that because the nature of this is that in the signal it can be wrong a lot and be whipsawed, which is not necessarily negative because it means you can still make money in treasuries. It's actually, I would argue, very hard to arbitrage away the anomaly, especially given the lagged effect of housing on the economy. And maybe you'll be right in the next 10 years. That's the thing about this stuff. It's like, I keep going back to buy and hold as a back test, right? Back tests fail when they're implemented, like the back test of buy and hold for the Nikkei. Right? Other questions?
What's the indicator telling you today?
So it's interesting. Again, I go back to conditions. The sentiment to me looks very, very dark. This is separate from the indicators. Utilities, also a risk-off indicator, collapsed the last couple of weeks. Okay? Utilities have been strong the bulk of the year. Lumber to gold has been weak the bulk of the year. Makes sense, right? There's always a duration aspect to defensiveness. So if you were to look, for example, at utilities and rank utilities in the S&P, okay? Historically, when utilities are among the top performing sectors of the S&P on a rolling three-quarter basis, it actually tends to be a low for equities. Why? Because if utilities are the top performing sector, you probably already went through a nasty bear market. Kind of makes sense, right? So utilities have gotten smashed the last several weeks relative to equities. Lumber to gold is finally starting to show some signs of life. Now, the fact that Brainard a couple of days ago said the Fed is aware or sees some fragility happening in markets, whatever the term that she used, is the Fed thinking about pivoting. That's what that statement was. Because we know she's talking about government debt. Because again, the Fed cannot do quantitative tightening in this kind of volatility. They'll crush the system. Then it's not about killing inflation, then it's about outright depression. So they're in a nasty spot, but all the indicators now are basically saying you're pretty much close to another risk-on period. Interestingly enough, that's all coinciding at the same time with October usually being the low, major low for equities, historically. In second year of a presidential cycle, those lows tend to occur in September 30, which I'm pretty sure is still the low and held. Maybe I'm wrong. And again, I go back to the sentiment is so dark. It's like you're probably due for some kind of rally. Now, I don't believe that the bear market's over, because I don't think you can have a bear market on equities be over until the housing bear market's over. And that's still pretty early. But again, who knows? Right? It's all about conditions and probabilities. But I do think that there's a tradable move here. That combined with the way the dollar looks like maybe it's starting to peak, maybe. Because again, if the dollar were to keep doing this, you have a sovereign debt crisis. Right? I find it hard to believe that central banks globally are not aware of what's happening, which means they could do something around dollar swap lines or something. So my base case here is that, yeah, you probably are going to have some kind of a heavy rally. The indicators are suggesting you're in a risk-on environment or starting to enter one, as everyone is still so bearish and everyone still thinks it's the end of the world. I keep making this point. It's like if it's the end of the world, you buy stocks because it doesn't matter anyway. It goes back to an analogy from the early 60s, okay, which is that if you have a nuclear missile, you buy stocks. If you have a nuclear war, you buy equities, because it doesn't matter anyway. My argument here on the end of the world is that if volatility in bonds doesn't subside, that's an end of the world for the system with so much leverage. So you can't bet on it because it doesn't matter anyway if you do. It's very binary in my eyes. I could be wrong, obviously, but again, I don't see how the system survives like this. So it seems very plausible. You cut off the tail risk, so bonds stabilize there. Equities would rally on that cutting off of the real systemic risk around interest rates. The indicators keep saying risk on because it would suggest that 30-year mortgage rates fall, which would be beneficial for housing for a moment in time. All right? And then you still probably have lower lows. But at that point, my hope would be, going back to that relationship I showed you, that you go back to this Treasury equity interaction as the flight to safety, risk off, default risk off behavior, where Treasuries end up being the beneficiary of another leg lower for equities. Selfishly, I need that. I need that for my funds. I need that. So I'm biased. But I do think there's a logic to that. Other questions?
Are you finding any other diversifiers or something else kind of either replacing or adding to the gold lumber?
So the question is, can you add, let's say, overlays or other ways of doing it? Okay. So I'm a fan of simplicity. So I often find that the more variables you have in an equation, the more it's likely to blow up, because every variable has an error rate. So now you've got cross correlations across error rates. So I'm not a fan of overcomplicating. Can you optimize it by having thresholds? Yeah, maybe. You could have argued that a better risk-off basket today would be to blend things, so Treasuries, gold, and the dollar. Gold does act as a risk-off safe haven. So when you have these high volatility periods in equities, gold does tend to do well historically. I have a chart on Twitter. It's basically a variation of this looking only at gold in the top 20 drawdowns. You see some pretty outsized gains in gold. The problem with gold is that if you're wrong playing defense, there's no yield, so you can't make money, right? And it's got its own dynamics with volatility. So it's not to say that it wouldn't work. I just tend to believe that if you're going to create a strategy, focus on something that might explain 50, 60% of why things act the way they do, and accept the truth, which is that the rest is probably randomness, then try to chase optimization. It's more of a mindset, I would argue. Go ahead, Dan.
I've been debating this in my head. Just curious, does the signal work if it's more of a precursor of sentiment or more of a precursor of fundamentals and actual arguments?
I would say it's a precursor in terms of the wealth effect, right? Because the wealth effect is not about the stock market. Even the Federal Reserve itself did a paper in 2007 where they basically argued the wealth effect is largely based on home prices. Right, which makes sense because that's most people's wealth, and because of HELOCs, credit creation, right? That there's a logic there. So to the extent that lumber is telling you about housing, which tells you about home prices increasing, which shows about added wealth and credit creation, that's the mechanism. Right?
So it kind of seems more like sentiment.
Yeah, to some extent, right? There would be an expectation that consumers are going to be wealthier, spend more, so you want to buy beta based on that, and you'd have lower volatility, presumably under that. We'll do a couple more quick questions, and I'll do the giveaway.
Could you talk a little bit more about the choice of 5-year treasury. This one is 20-year treasury. I mean,
Yeah.
like a
Why the
1-year
duration?
Treasury right now, it's like, I mean,
Yeah.
like 4%. Like, you know,
Yeah, no, 100%.
Super. I'm just
Right.
curious, like, those relationships, you know, this clearly tells you I'm an equity guy.
Yeah.
I learn a little bit about fixed income.
No, you're exactly right. So, and right now, you're right. You can certainly make more money from a buy and hold perspective with 1-year treasuries than you could a year ago. Like, to your point about 4%.
Yeah.
Right. The idea is, remember, this is not about the end point, but the interaction, the sequence. So you want longer duration when you have volatility in equities, which is what drawdowns tend to coincide with, right? You want longer duration because you want more oomph to make money in that moment in time as opposed to the buy and hold of get your principal back plus interest. Right? If you think about sort of TLT versus an IEI or SHI ETF, you get much more movement with TLT. You want to play that volatility in treasuries, hopefully being beneficial when you have equity volatility. Right? That's the argument. It's really just a function of how much the risk-off side would move. Now, the higher the yield, the less every basis point matters for price movement. Right? Because the lower your starting point, obviously, the more violent your price percentage changes will be. So you certainly could do it now. It wouldn't work as well historically because, again, you want to try to get that oomph, which is what longer duration will typically give you if you happen to be right being risk-off in advance of a stock market decline. Again, it goes back to the opportunity
I'm
set.
thinking about it too defensively when you're saying bang for your buck.
Yeah, it's like if you want to get the convexity, right? The real kind of move where treasury. And this is why my mutual fund was up 72 in 2020, right? Because it could have been in shorter duration, but it wouldn't have been up in the midst of the COVID crash 40% of the 72. Right? It's you're playing for being right when you're risk off. Let me do the giveaway and we'll do some more questions. Hey, where's the? Okay.
The left side of the room kept the baskets.
Oh, you want it? Yeah. Good call. You want it? Yeah. No. It's good. Pass it around.
Let's get a full sample size.
Yeah, right. Exactly. No small sample bias here. And everybody, please only put one of your business cards in.
Yeah, you didn't say it. I thought about it.
Yeah. No, I had somebody in Florida do that. She put 5 of her business cards in. She didn't win, but I was like, wow, that's.
A lot of scams in
That's.
Florida.
I was tempted to report her to the CFA for a code of ethics violation.
She actually owns a business card company.
Right. She was just promoting herself, exactly. Anyone else? Yeah. By the way, whoever I choose, I'll get to your question in a second. Whoever I choose, just do me a favor. Clap. I've done this enough times to know that people are always like, shit, it's not me. By the way, if you haven't noticed, I tend to curse a lot. There are studies that show that cursing is perceived as a sign of intelligence.
I don't know what the fuck you're talking
Yeah, exactly. Thank you. That's exactly right. So I apologize for that. Hopefully this isn't being recorded. So. All right, the winner of the Kindle is James Borges. Oh, that's funny. There you go. The man who complained about it wins, huh?
Don't look through the rest of the stack.
Yeah, right. Exactly. Anyway, I'm happy to answer other questions. So if, we'll do maybe one or two, and then we'll wrap up.
Your observation that it's the end of the world and therefore you're bullish is predicated on the Fed understanding that it's the end of the world.
Yeah, that's right. To some extent, yes. Yes.
And as we saw the Bank of England,
Yeah. Telling the pension plans, right?
you need to adjust your portfolios, i.e. you need to keep selling. We're not going to help you.
Yeah.
Where do you think that flips, and do you think it will flip before something terrible happens?
Yeah, it's a good question. So the point is that, is this being done purposely, and they may be aware of it, but they don't really care. It is amazing, right? It was, a week or two ago, the United Nations, for the first time ever, commented on global central banks. Like, there's some real panic going on, people.
Yep.
Like, my hell becomes everyone else's hell. Right? It's a good question. I don't know why it is that they don't seem to think that there's an illiquidity issue, because it's clearly an illiquidity issue, which kind of makes sense because they were the only real buyers, right? So it's like now they're saying, well, we're going to run off the balance sheets and it'll be fine. There's no other buyers but us, but it'll be fine. Like, it seems weird, right, just to argue that. I don't know. It's a strange dynamic, but the argument that something has to break to me is not really valid, because again, if you break at these levels with leverage this high, it's like permanently broken. You're talking about margin calls on a scale we've never seen before globally. So I don't think they're going to wait that long. But who the hell knows? The thing with all this talk about inflation, it's like people keep saying this line, the Fed is going to hike rates until inflation starts going lower. The inflation data, I just did a Twitter space, Eric Basmajian, who's a great economic researcher, just yesterday, made this point, and I've been hammering this too. It's like the CPI data that you see today is from hiking rates from months ago. There's a lag. Right? It's like, oh, the Fed has to hike rates until it's, solidly beaten inflation. No. They can stop here. Inflation can keep going down. The damage is already done. All right? I don't know if it's a game of chicken or if it's trying to see if the market will call the Bank of England's bluff. But keep in mind also that there are pivots happening, just not necessarily in the Fed. It started 3 weeks ago with Bank of Japan, started then the Bank of England, and then the Reserve Bank of Australia basically did a more dovish hike. So other central banks, people forget there's a lot of other central banks than just the Fed. Obviously the Fed's most important. But there's a lot of other central banks that are already starting to say like this, we got to cool it on this. But if they want to destroy the system, they know how to. My father, I have this clip I always put out on Twitter of my father talking about interest rates, saying they're the heart, soul, and life of the free enterprise system. You want to cause a depression next week, raise rates by 500%. That easy. It's beyond inflation at this point. There's something really, I don't know. And it's beyond the argument of a duration bubble. I know disagreements on the hunt for yield, but it's like, again, how can you plan for anything as far as you being a CEO when rates are acting like this? So if everybody starts saying we're going to pause and not do anything until rates stabilize, it destroys everything. It's literally an economic lockdown. I put that line out on Twitter before. It's like the Fed is putting us in economic lockdown all over again with much more debt. Other questions? Any other questions?
Does your personal health just get worse if bonds can rally off this at a stronger pace than equities?
No, what I desperately need is bonds to rally, or at least to hold, to not be down as much as equities. I need risk off to act risk off in the volatility, right? So that's my only hope. I mean, and it's strange because people say hope is not a strategy. It's like, yeah, hope is a strategy. Of course it is, because it means you stick around with your strategy long enough to see the other side of it. You have to have hope to have discipline, right? So as long as this dynamic stops, I have a chance. In 2011, that RoRo index, real quick, that RoRo index I showed you, which again, it's a back test, fine, granted. But in 2011, the RoRo index was up 80%. The S&P was flat in 2011, rotating 1.3 times small large growth or TLT. Why was it up 80% in 2011? Because in 2011, you had the S&P debt downgrade, Treasuries rallied in price, yields collapsed, and stocks collapsed. It's in Treasuries in advance, so you get the down capture avoidance, right? And then on top of that, it gets a couple of these risk-on trades, and with the Eurozone crisis, as you had this insane volatility towards the latter half of 2011. That's my hope. I know that in at least the theoretical backtest and sequence, it's not impossible to have a very outsized gain, even with the S&P flat if I have the right interaction. Just like I did this live with my mutual fund in 2020 being up 72%. So, but I need this garbage to stop, and we all do, because again, it's if your safe collateral is acting like a penny stock, you have bigger things to worry about than the value of your portfolios. Any other questions?
Okay, well, Michael, thank you very much. Really appreciate your time. This will be posted on the CFA Virginia website in the next couple of weeks. We'll make sure to edit it so it's family friendly.
Bleep out the curses.
Yeah.
bleep out the curses, please.
Our next presentation is Wednesday, October the 26th. It's going to be virtual, so make sure to check your emails. And again, Michael, thank you, and look forward to seeing everyone soon.
Thank you. Thank you. Those on Twitter, I'm doing another space in about an hour and a half. Thank you, buddy.